Hey, what's up, everybody? Welcome back to Investing Sucks. So today is going to be the third installment of the Your Company, My Analysis series. This is a series where I take companies that you guys suggest to me and I give you my thoughts on them. We go in depth on their financials, the trends happening in the industry, and then I do a valuation of the company to help us determine if it's a good time to look into this company as a potential investment. So today we're going to be looking at Restaurant Brands International, or RBI. So this is a company I'm definitely interested in looking at further because, as you'll see in this video, there's definitely reason to be interested in this company. We'll do the valuation on them. And once we get to that, you'll kind of see why that, given the company and kind of their history and their future prospects, as we can kind of decipher what those may be, this company does actually present pretty good value, in my opinion, in terms of what the price is now relative to how much money the company is actually making. So let's first dive into who this company is. Now, I'm sure a lot of people are already familiar with this, but we'll go to the description here. So for those who don't know, it's pretty much just they own fast food restaurants. So Tim Hortons, Burger King, they actually started about 5 or 6 years ago when Burger King and Tim Hortons merged into one, and then they've since acquired Popeyes, which is a pretty fast growing fast food company. And the past year, they bought another one, Firehouse Subs. So right now they have 4 total fast food restaurants underneath their arms. So the company's strategy is really quite simple. It's really just acquire and grow fast food restaurants, right? That's pretty much all they do as a company. It's not super complicated, and it's a pretty easy business to understand, in my opinion. So if we go to their company presentation here, we can scroll down. So they hadn't bought Firehouse Subs at the point of this presentation, so they're not included, but they do give some data on Burger King, Tim Hortons, and Popeyes, and you can kind of get an idea of the relative size of them. So you can see Burger King is the biggest in terms of the number of restaurants it has. Tim Hortons has about 5,000. And then Popeyes, not that far under. But as we'll see when we go to the actual revenue section, Popeyes as a percentage of the company's revenue is relatively quite small compared to Tim Hortons and Burger King, which is significant. We'll get into why that's significant later on. So here is the most recent 10K for RBI, and they give some segmented information. So this is something I was particularly interested in because I wanted to see the revenue trends in each of these restaurants. Which one's growing fast, which ones aren't growing or maybe growing slowly. And the first thing you kind of notice is 2020. Tim Hortons and Burger King kind of had drop-offs compared to 2019, but they have since recovered and have grown overall since then. However, Popeyes was pretty much the opposite, which is interesting. They actually had very, very strong growth from 2019 to 2020. So from the non-lockdown year into the lockdown year. So that's pretty interesting, I found. And even going into 2021, still very strong growth. So Popeyes is clearly the fastest growing restaurant out of all of them. And Tim Hortons and Burger King kind of seem like they're more in, a stagnant or not really growing that fast phase. And then if you look at the revenue by country, it's mainly going to be North America. Pretty much all is North America. That's where most of their restaurants are, with a big chunk of it being in Canada. And so because this company is a restaurant, you kind of got to understand the breakdown of their revenue from corporate owned stores versus franchised owned stores. That's going to be that's because they're completely different business models. Running a franchise versus a corporate owned store, there's different strategies that go into that there. So it's kind of half and half when you look at it. They do have some revenue from advertising revenue, which is really just this fund that they have that their companies contribute to, that they designate for specifically advertising expenses. But in terms of the breakdown between sales from corporate owned stores and franchises, it's essentially half and half, and it's kind of been that way for a long time. So that's significant because if you're projecting them out into the future, you want to see how that changes because that's going to impact the profit margins that you have. Because franchised operations, when you're really just collecting a franchise fee from your restaurants, you're most of the time going to have a higher profit margin than if you're running the actual restaurant itself, because it's a bit more of a passive business model in that sense. Okay, so the next thing I want to do is take a look at some historical valuation metrics. So this is going to help us determine kind of how a company has been valued by the markets historically. So I'm going to first look at price to sales. I like to look at price to sales first because it really gives you an idea of how much the market values $1 of sales with this particular company. And this can change for a few different reasons. One, if their operating margins or profit margins in general increase, that will naturally raise the price to sales ratio because now each dollar of sales becomes more valuable. or if just the sentiment around that company becomes increasingly positive for whatever reason. It could be from news, it could be from, the just general consensus around the company changing and people believing that management is better and the company has better future prospects, whatever the case may be. So looking historically, no real discernible trend. It's kind of up and down. You can see it went down quite significantly in early 2020, as a lot of companies did. It was quite high at that point, around 3.5. And it's come down a sizable amount in the last few months, it looks like here. So 3.5 all the way down to under 3 and about 2.8. So 2.8 kind of looks like it's a little bit in the middle in terms of a historical average. So, and the company is really only about 7 years old at this point, because that's when the merger took place. So it was low at this point, but that could have been for a number of reasons. So the other one I like to look at is enterprise value to unlevered free cash flow. So unlevered free cash flow is what we use when we actually do the DCF model later in the video. So this one's going to be a lot more volatile because it does change whenever they report their free cash flow. And again, no real discernible trend. It's kind of up and down, but you can see it came down quite a decent amount, currently at about 20x, which does look kind of in the middle. I mean, it seems like most of the time it was above that. So no real insights to be drawn from their valuation metrics here, I'd say, probably just because they are a relatively new company. They've only been around 7 years, which is pretty new when you're looking at, a long history of finances for a company. But the next thing we'll do is take a look at their actual financial statements and see if we can learn a bit more about them. So you can see 2015, that's kind of when the merger took place. And since then, they have had pretty strong revenue growth. We can see double digits here, fell off quite a lot in 2020, which we know why that is, but recovered strongly, 15% there. And their gross margins have been rather consistent. They went down in 2020, but usually hovering around the 42% range, and operating margins fluctuating a bit more, but seems to be in the low to mid 30s. So this is something we're going to keep in mind when we actually do our DCF model, because operating margin is a key input into that. All right, next, let's take a look at the balance sheet. So they made that acquisition of Firehouse Subs recently. So I would be interested in seeing how they actually paid for that. So for that, I'm actually going to go to the cash flow statement. So they generated about 1.7 billion in cash from operations last year and had very low capital expenditures. So in terms of free cash flow, that's about 1.6 billion in free cash flow. And if we check the current market cap of the company at 18 billion, that's a pretty low multiple to actual free cash flow. So that's probably a reason why some notable investors, specifically Bill Ackman, have recently built a position in this company. So what's cool about Ticker Terminal is you can actually track a lot of these very famous funds, so a lot of notable investors. So I think Pershing Square, that's Bill Ackman's fund. And you can see here it is, Restaurant Brands International, 9% of his portfolio. So that is a sizable amount of his portfolio that's in restaurant brands. So he clearly sees something in this company that not a lot of other people see, because he's very heavily weighted it. But granted, he does have a pretty concentrated portfolio, which I think is his investment strategy. And it's an investment strategy that I think is gaining a lot more steam now, where people are saying, you should really focus your energy and your investments on a few companies that you know really well and have high conviction in. So I think he is kind of unique in the way he manages his fund in that case, because there's not a lot of companies in here, and they tend to be like pretty similar style of companies. He has Chipotle, Restaurant Brands International, and Domino's Pizza, which are all pretty much in the same industry, right? Fast food. He also has Canadian Pacific Railway, which is interesting. But if we take a look at pretty much any other fund that's on here, they're probably going to have a lot more holdings. So just pick one at random and we'll see how many holdings they have. So you can see here, they have a lot more holdings than Bill Ackman's fund. I mean, most of the time these funds are going to have from 20 to 30 different holdings. And I've noticed Micron is a pretty common holding in a lot of value investors' portfolios. So that might be a company that's worth doing some digging on. But yeah, just a quick note on Bill Ackman's investing style. Pretty interesting investing style. So he clearly sees something in this company, and probably a big reason is, I'd imagine, the cash flow generation capabilities. So, I mean, 1.7 billion in free cash flow, or 1.6 billion, call it, for a company that's valued at 18 billion. That's a pretty low multiple. And I would consider RBI a pretty high quality business. The restaurants they own are pretty strong brands. Burger King, Tim Hortons is obviously a strong brand here in Canada. Firehouse Subs is another one that's kind of up and coming. And Popeyes, as we'll see in a bit, is growing their revenue really fast and it's gaining a lot of steam. But in terms of the acquisitions, so this would be the Firehouse acquisition here. So just over $1 billion, and they're actually able to fund all of it using their cash flow from operations, which is great. So that means probably no further dilution, which I think that's a good business model to have. If you can fund acquisitions with internal cash flow, then I mean, that's Constellation Software. That's pretty much their whole business model, is just doing that over and over again. But let's go back to the balance sheet and actually see what we can learn about them here. So one thing I did notice is that they are funded pretty significantly by debt. And there's a reason for that. It doesn't make the company necessarily very high risk. And they actually have a pretty low interest rate on their debt. From what I saw, it was usually in the range of 3.5% on most of their debt, which is a fairly low interest rate. So that means they probably have a strong credit rating. So even though they are funded by a lot of debt, you can see 19 billion in liabilities and only just under 4 billion in equity. So about just under a 4 debt to equity ratio. For most companies, that's considered highly leveraged. But a lot of it is this long-term debt, which all they do is they get loans, they purchase these properties, and they lease those properties to their franchisees. A lot of the properties that their franchisees have, so all the Tim Hortons, Popeyes, Burger Kings, are leased to them from RBI. So there's really not a whole lot of risk there because they're just buying the property and leasing it to, their own brand essentially. So unless the whole business starts failing and those companies aren't getting sales and they can't afford to pay their rent, then this large amount of debt isn't really going to be an issue, which if that's happening, then the company's probably already failing anyways. So that's kind of what you can discern from that. And you can also understand that the credit rating probably isn't that much of a risk if they have an interest rate that's in the 2.5 to 3.5%, because that is quite low. So, assuming the credit rating agencies are doing their job, then I think the company is financially strong. Okay, so next I'm going to dive right into the discounted cash flow valuation section. So that's what I have on screen here. And I'm going to post this spreadsheet in the link in the description of this video for you guys to download into Excel and take a look at in case you guys do want to learn more about, the work I did here, because I know some people are interested in diving a little bit deeper than I go to in these videos. But I'm going to skip the industry trends and analysis section for this video, just because it's a pretty simple industry, right? The fast food industry, if you just do some basic research, you'll learn that it's kind of a more mature industry that's growing in the low single digits per year as a whole. What's more interesting to look at is the trend in the actual sales of the stores themselves. So that's what we're going to do here. So Burger King, I kind of took the past. So I went back to about 5 or 6 years to look at how much sales each one was generating. And you can see Tim Hortons is not growing that fast, only 2% compounded over this time period here. And then Burger King was a bit higher at about 7%. And Popeyes was by far the highest. They're actually growing quite fast as a business overall. And then you also have to account for the Firehouse acquisition here. So I had to do a little bit of work in order to understand how much sales they would have generated in 2021. So they reported 5 million in sales on their income statement for the most recent year, but that was only for 12 calendar days. So I essentially just prorated that for a full year, and you would have got about 152 million. And based on the historical growth in locations of Firehouse, they were growing their locations. They grew them 3x in the last 10 years, which I believe is about an 11 or 12% compounded growth rate. And you can assume sales will be pretty much comparable to that. So what I'm trying to do here is take their historic growth rates and then just go a little bit more conservative. So 1% growth with Tim Hortons, 5% with Burger King, and then 15 with Popeyes and 10 with Firehouse. So all of those are just slightly a few percentage points lower than what, from I could tell, their growth has been in the past. And then you just project it out to the future. And these sales include all the different types of sales. So all the advertising sales that we talked about, the franchise, and the corporate owned stores. So this is all sales. So if they follow those trends, then by the year 2028, which I did a 7-year analysis in this, they'll be just under 8 billion in sales for RBI as a whole. So then that's what I put into here. And I think doing that is a bit more valuable than doing any sort of industry trend, because I did a little bit of research and it was hard to find anything that was more insightful than just, a few basic research reports saying that the fast food industry will grow at 2% projected over the next 5 years. So I think that's a little bit better. So I engineered the revenue growth to meet that target. So just under 8 billion in sales. For the EBIT margin or the operating margin, I went 35%, and I'm not assuming that it's going to change at all. So that even split between franchise revenue and other revenue, such as the corporate owned store revenue, will stay the same, which I think that's a reasonable assumption. They do have a very low tax rate from what I could tell. They did this tax inversion when they did that merger of the company where they kind of incorporated the parent company in a low income tax area, but retained the company's operations in Canada and North America, because that's where all the stores were. So a low tax rate. And then the perpetual growth rate I put at 1%. So that's growth from 2028 and beyond. Now their cost of capital is only 6.5%, and it actually is quite low. So I'll show this part, basically just taking their debt, their equity, and comparing the two. They are, as we saw before, funded a lot by debt. This is pretty high. I've done a lot of these analyses now on Canadian companies, and I don't recall seeing one that was funded 48% by debt, whereas the market cap was only 18.3 billion. So, but like we said, it's not really a risk because they essentially operate like a real estate investment trust where they get a loan, buy a property, and then just lease the property out to one of their own stores. Now, I did assume that their shares outstanding will shrink into the future years. They are planning to do share buybacks. That's one way they're going to use their free cash flow. But they do have share-based compensation, which naturally will cause dilution. So I think this is a pretty conservative assumption because they did plan on spending multiple billions on share buybacks. So there is a good chance it could be more of that, but I like to keep my models rather conservative because you want to leave room for upside in them. So given all these assumptions, and then I went pretty basic with the capital expenditures and the depreciation, amortization, working capital investments kind of averaged out to zero over time. So we can get this stream of unlevered free cash flows that we project for them into the future years. And then we discount those to the present to get our enterprise value. So enterprise value is 43 or 45 billion. So we add cash, which in 2028, I just gave a rough estimate, 1.5 billion in cash, interest-bearing debt, 20 billion, which keep in mind now they have about 13.5 billion. So that's probably going to go up as they expand their stores into the future years, which we are assuming that their sales are going to grow. And in order for those sales to grow, they need to open more stores. And in order to open more stores, they need to take on more debt because that's how they do that. So that's an assumption that you have to make. And then, so we get a fair value per share of actually 89. So this is in USD, 89 USD, and their current price is about 59 USD. So from that, you can kind of understand why Bill Ackman would like this stock, because from what I can tell, from what I think are pretty reasonable and conservative assumptions, it's quite discounted. Now, it's not at the screaming buy range where it's about half or even below half of your calculated fair value. And keep in mind, we are discounting these cash flows at only 6.5%. So at 6.5%, you're really only looking at about a 10% estimated annual return over your 7-year investment time horizon, which, depending on what the market does, because a lot of people are calling for low returns in equities over the next decade. So maybe this, even if it's only 10%, maybe that could still outperform the broader market. But really, if you're going to be taking on the additional risk of putting your money into a single company, you're probably going to want a higher return than that. So let's play around with the assumptions a bit and see what kind of numbers we can get. So let's say we increase their operating margin to 35% or 38% here. And if we go back to their income statement, we can see that their operating margin averaging 38% into the distant future is not really out of question, because we can see in these 2 years here, it was in the 40s and then kind of in 36 range. And then it kind of came down a lot in 2020, which wasn't a good year for them. So 38%, I don't think that's out of question, but I think if you're trying to be reasonable, then you would probably want to have it a bit lower. But let's just see what happens when we make things more optimistic. So 38%, let's go down to our return. And we can see that actually had a pretty significant impact. That brought it to about 9.5% to 11%. Now, when you're looking at 11%, that's when I think you should get more interested in a company, especially when you consider that our fair value is 100 and our current price is just under 60. So it's pretty discounted at that point, right? You're kind of in the buy range. Personally, I like to look at between 50 and 60% with, what I think are reasonable assumptions for me to actually get more interested in a company. But let's play around with the assumptions a bit more. Let's actually look at this revenue section and say, what if instead of, what if Popeyes, for example, because we know this one's growing pretty fast, continues its growth at 19% compounded. So 8.4 billion revenue. So let's increase these numbers so we can get closer to that. So let's make this, all right, that's pretty close there. I'll just change that maybe a bit lower. All right, close enough. And we can see what our return does. So that didn't really have much of an impact. So sales growth is going to be important. And Popeyes growing fast is obviously great, but it's still such a small portion of the company that even if it grows at a very high rate, it's not going to impact your return that much. For example, if Popeyes grew at, say, 25% compounded, but say Burger King only grew at 2% and say Tim Hortons actually shrank, then overall, you're getting worse growth, right? So, Popeyes, it's a great business to own based on what I can tell. But if you're pairing that with, a not so great business, which, who knows what the future will hold for these companies, then that might eat into your returns a bit. But overall, I would say this is a company I am interested in doing more research on. And I'm not just saying that because Bill Ackman owns it. And I think that, I should just copy whatever he's doing because he knows better than me. I don't doubt that he's more knowledgeable on investing than I am, but I'm not going to just sit here and say, because one investor bought it, I'm going to go and buy it as well. I kind of want to think independently when I go about these things, but from what I can tell, the company does offer pretty good value. There are a few things to be concerned about, but it does have very strong brands. All these brands are very strong, very recognizable. And there's a lot to like. It's valued rather cheaply from what I can tell. And the business model of, I would say it's kind of been helped by low interest rates because they're able to acquire this financing for very cheap. And if, that is a bit of a risk, because if interest rates rise into the future, which the central banks might have to do as a means of controlling inflation, we'll still see what happens there, but that could hurt the business model. So that's one risk that I would consider as well, is if interest rates go to 6 or 7% in the next, say, 3-5 years down the road, are they still going to be able to grow their stores with such cheap financing? It might be a little bit slower in order to do that, but there seems to be a good margin of safety built in at the current price. But anyways, guys, that pretty much does it for me for this video. So thank you so much for sticking around and listening to my analysis. I really hope you did find it useful. If you did find it useful, then leave this video a like. And if you're new to my channel, then please consider subscribing. I have a lot more videos like this planned. And I'll see you guys in the next video.